There's a portion of my clients that have difficulties qualifying with traditional lenders based on what their tax returns look like. Self-employed borrowers, and I've got about 6 different programs that I can use for a self-employed borrower to help them qualify. The first one is the most prevalent one and is the one that I use the most. It's a bank statement loan where I'm able to take the last 12 months worth of bank statements, add up all their deposits, and divide that by 2 because they'll allow them to use 50% of those deposits and apply that money as income to qualify for getting a mortgage. Had a client recently where his tax returns just did not support the income that he needed in order to qualify. And I said, hey, can we take a look at your bank statements? He says, I've looked at a traditional lender. I'm trying to qualify for some investment properties, and I can't use the debt service ratio loan, which I'm going to talk to you about a little later. And I just can't figure out, they can't figure out a way to qualify. He had gone to 3 or 4 different places. And I was like, can I look at your bank statements for the last 12 months? He says, absolutely. I'll give you my last 12 months bank statements. So he gave me his last 12 month bank statements. We added them up and it came up to $19 million too. And that gives us $9.5 million. Okay. That's a lot of money, but he only owns 27% of the company. So he can only use 27% of that, which ends up being about $2.5 million. Guess what? $2.5 million annually is a lot of income. And so we could use that income to help him qualify for those investment properties that he didn't want to buy. He was actually looking to refinance them. Okay. Next client, had a client who had started a business several years ago and she wasn't working the business. And so what we ended up doing with that is she wasn't working the business, but she had started working the business within the last 12 months. So the bank statement loan didn't work for me because she really had only started receiving income for the last 6 months. So what we ended up doing with her is we ended up doing a profit and loss. So she was able to show sufficient income over the last 12 months, even though she's only earned the money in the last 6 months, but we're using the last 12 months worth of income. The income that she received over the last 6 months based on her expenses helped her qualify for the mortgage. A traditional lender is basically going to say, you need to be on the job for at least 12 months. You need to show bank statements for the last 12 months. You need to show tax returns for the last 2 years. In this particular case, we were able to use 12 months worth of her profit and loss to help her qualify for a loan. All right. The next way that we have to qualify self-employed borrowers is if they have substantial assets. So we're going to talk about an asset depletion loan. All right. Basically, that means you've got a borrower they've got money, they've got money in the bank. So we're looking at the cash that they have in the bank and we're using a percentage of it. And the percentage is going to vary if they've got money in retirement and if they've got money in stocks and bonds. And then if they've got money in cash would give them 100%. Stocks and bonds, we typically give them about 70%. Their retirement accounts, typically it's 70%. Sometimes it's different depending on which lender or investor that we're going to end up using for the particular product. And we're going to give them that money as annual income. So we'll take the total amount of assets they have in the bank after I've applied my percentage knockdown on each one of them. I'm going to do a really easy one right now. The client has $7 million. If I take that number and I divide it by 7, they're going to have $1 million left. I can use that $1 million as income to qualify them on an annual basis. So I take that, I divide it by 12, and that's the income that I'm going to use to qualify them. Great loan. I've had several clients that I've actually been able to use that for, and it's really easy because all I have to do is see their bank statements. Everything else, no tax return. Makes their life a lot easier. The next program I want to talk about is an asset-based loan. If a borrower has sufficient assets over and beyond the cost of the house, we will give them a mortgage. I had a client. She worked for a company where she received a huge amount of stock options. The company went public and she took a sabbatical for a couple of years. So she had no income at all. None. Nothing coming in. But she got a job and the job was a contracting job. So basically when it's a contracting job, after she's taken a sabbatical for a couple of years, she's self-employed. So once again, we run into that needing to be on the job 12 months, having 12 months bank statements, having 12 months on a tax return. She didn't have that. She had only been with the company for 2 months, but she had more than enough money to pay for the property. Actually, she had twice as much money to pay for the property in cash. And since she had those assets, I was actually able to give her a loan totally based on the assets, just that she had sufficient assets to pay cash for the property plus some. So that's an excellent loan to be able to use. We're going to talk about DSCR loans, debt service coverage ratio loans. What the heck does that mean? It means if you have sufficient rents on the property, we can prove that there are sufficient rents on the property, and the mortgage payment is equal to or less than the rents on the property, you can qualify for the property based on the rents alone. So we don't have to verify any income at all. Amazing loan for investors who want to purchase properties. Next loan I want to talk about is short-term rental income loan. It's called an Airbnb loan. So I can actually use rents from an Airbnb to qualify for a property, similar to a debt service coverage ratio loan, but taking into account short-term rental incomes. There's a service that we use that will tell us what the income is on the property. And if the income is sufficient on that service, we will be able to use that rental income to qualify for the loan if you have a property that's in an area that can be a short-term rental. So we could take a look at that also. So therefore, just looking at the short-term rental income to qualify for a loan. That's all I've got for today. Cheers.